Welcome back to the deep dive. You know how some sectors are practically famous for showering investors with dividends?
Right.
Today, we're looking at one that's, well, not exactly known for its generosity.
Okay.
Healthcare.
Interesting.
And yet, we're diving into a recent article that has some surprising takes on two big names in the game.
I see.
And which one might be a better bet for your portfolio? Right off the bat, it's important to remember that healthcare as a sector isn't usually where you go hunting for the highest dividend yields.
Yeah, it makes sense.
Out of the 11 sectors in the S&P 500, it comes in eighth. Not exactly setting the income investing world on fire.
Right, exactly. And that's why this deep dive is so interesting. We're looking at Pfizer, the pharmaceutical giant behind the COVID-19 vaccine, Comirnaty,
Right.
and Walgreens Boots Alliance, the pharmacy chain that seems to have a store on every corner. They're both household names, but their recent performance, let's just say it's been a tale of two very different trajectories.
Yeah, let's start with Pfizer. Their stock has been on a bit of a roller coaster ride these past couple of years, hasn't it?
Indeed it has. Since its peak back in late 2021, Pfizer's share price has taken a tumble,
Yeah.
dropping by over 50%. Even with a bit of a rebound this year, it's still lagging behind the overall market.
So what's going on there? Did the COVID-19 vaccine frenzy finally fizzle out?
Well, that's definitely a factor. Remember those eye-popping Comirnaty sales figures?
Oh, yeah.
Yeah, those have come back down to earth. In 2022, that vaccine brought in a massive $37.8 billion
Wow.
by 2024. Pfizer's projecting sales closer to $5 billion. That's a significant drop, even for a company of Pfizer's size.
It's like that saying, what goes up must come down. But on top of that, didn't Pfizer have some key patents expiring soon? That's gotta hurt.
You're right, the dreaded patent cliff is looming. Several of their blockbuster drugs are about to lose that exclusive patent protection, which means more competition from generics and likely lower prices. We're talking about major medications for cancer and autoimmune diseases. Inlyta for kidney cancer and Xeljanz for autoimmune diseases are set to lose protection next year. And it doesn't stop there.
Oh, no.
Ibrance, a key drug in their breast cancer portfolio, and Xtandi, a major treatment for prostate cancer, will lose patent protection in 2027. And those are big players in the respective markets.
Some more competition, potential price wars.
Yeah.
That doesn't sound great for Pfizer's bottom line. With all this doom and gloom, why is anyone even whispering the word buy when it comes to Pfizer? What's the article seeing that everyone else is missing?
That's where things get interesting. See, despite these challenges, there are some compelling arguments for why Pfizer might be a smart buy right now, especially if you're an income-focused investor.
Okay.
The first thing to remember is that Pfizer currently offers a hefty forward dividend yield of 5.66%.
Hold on, 5.66%. That's pretty impressive for any company, let alone one facing the headwinds we just talked about.
Exactly. And here's the kicker. Pfizer has been very vocal about their commitment to not just maintaining that dividend, but actually growing it.
Okay, so they're saying all the right things about keeping those dividends coming.
Right.
But with their revenue streams drying up and competition heating up, how can they realistically afford to sustain such a high yield, let alone increase it?
That's the million-dollar question, isn't it? And this is where understanding a bit about forward earnings comes in handy.
Okay.
It's not just about what a company is earning today, but what analysts project them to earn in the future.
So we're talking about potential, about betting on Pfizer's ability to innovate its way out of this situation.
Exactly.
What's their strategy? Are they just slashing costs and hoping for the best, or do they have a real plan?
They're actually doing quite the opposite. While cost-cutting is certainly part of the equation for any company, Pfizer's management is banking on a two-pronged approach, investing heavily in research and development to bring new drugs to market, and making strategic acquisitions to expand their portfolio. They're not just trying to weather the storm. They're looking to come out stronger on the other side.
So instead of battening down the hatches, they're setting sail for new horizons. I like the sound of that. But what does this innovation look like in practice? What are some of the promising new treatments or products that have analysts feeling optimistic about Pfizer's future?
One of their most talked about prospects is an experimental obesity drug called danuglipron.
Now, obesity is a massive problem with a huge potential market. A breakthrough drug in that area could be a game changer for Pfizer, couldn't it?
Absolutely. And they're not putting all their eggs in one basket. This year alone, they've pushed 3 new cancer therapies into late-stage clinical trials. These are treatments for some of the most aggressive and difficult-to-treat cancers, so the potential impact is huge, both for patients and for Pfizer's bottom line.
3 new cancer therapies in late-stage trials. That's big.
It is.
So they're making big bets on the future. But it's not just about throwing money at research and hoping something sticks. What makes Pfizer's approach to R&D stand out? What are they doing differently?
That's a great question, and it's something that stood out to me in the article as well. Pfizer is investing heavily in cutting-edge technologies like gene editing and mRNA therapeutics. These are fields with enormous potential to revolutionize how we treat a wide range of diseases, from cancer and rare genetic disorders to infectious diseases and even autoimmune conditions. They're not just tweaking existing treatments, they're looking to rewrite the rules of medicine altogether.
So instead of incremental improvements, they're aiming for breakthroughs. Bold move, Pfizer. But investing in unproven technologies carries a lot of risks, doesn't it?
It absolutely does. These are still early days for these technologies, and there's no guarantee that they'll pan out the way Pfizer hopes. But that's the nature of innovation, isn't it? You have to be willing to take calculated risks to achieve those groundbreaking results.
And that's what Pfizer has been known for throughout its history.
Right.
Think about it. They developed the first oral polio vaccine, the first effective treatment for tuberculosis, and, of course, played a critical role in the fight against COVID-19. They've got a long track record of innovation, even when it comes to taking those big swings.
Absolutely.
So they're not afraid of a challenge. They've faced down their fair share of patent cliffs and shifting market dynamics before. But here's what I don't understand. If Pfizer has such a solid track record, if analysts are excited about their pipeline and their commitment to that dividend, why is their stock still trading at a discount?
It seems many investors are focusing on the short-term challenges and overlooking the bigger picture. They see the patent cliff, the declining vaccine sales, and they hit the panic button. What they're missing is that Pfizer is already taking steps to address these challenges, and, more importantly, they're investing heavily in a future that goes far beyond those short-term headwinds.
So we're talking about a classic case of short-term thinking versus long-term potential. And the article argues that right now, Pfizer's stock price doesn't reflect its true value.
Exactly. The company is currently trading at a very attractive valuation, only 10.5 times its forward earnings.
Wow.
Considering their growth prospects, their track record of innovation, and their commitment to that juicy dividend, the article suggests that Pfizer might just be a compelling buy for investors with a long-term perspective. They're essentially saying that the market is undervaluing Pfizer's potential and that savvy investors should take notice.
Pfizer, the potential comeback kid of the pharmaceutical world. It's an intriguing argument for sure. But before we get too caught up in the excitement of a potential Pfizer rebound, we've got another healthcare heavyweight to examine, Walgreens Boots Alliance. And they're boasting an even higher dividend yield than Pfizer, aren't they?
That's right. Walgreens is currently offering a dividend yield north of 9%. But as with any investment, and especially in the healthcare sector, it's crucial to look beyond those surface-level numbers.
Okay, let's peel back the layers and see what's really going on with Walgreens. Where do we even begin?
Well, let's just say that compared to Walgreens, Pfizer's recent performance might feel like a walk in the park.
Uh-oh, that doesn't sound good at all. So how bad are we talking? Give me the rundown on Walgreens' woes.
Walgreens stock has been on a downward spiral, plummeting nearly 80% from its peak just 3 years ago.
Wow.
To make matters worse, they've lost over half their market value in 2024 alone. We're talking about a company facing some serious market headwinds.
Those are some pretty bleak statistics.
Yeah.
It sounds like they're caught in a perfect storm of challenges.
Right. Remember how Pfizer's financials were on the upswing?
Yeah.
Well, Walgreens is painting a very different picture.
Okay.
Their most recent earnings report wasn't exactly cause for celebration.
Right.
Their adjusted earnings per share took a significant hit,
Oh, no.
dropping by 40.8% compared to the same quarter last year.
Wow.
And their forecast for fiscal year 2025 isn't looking much better.
So we've got a plunging stock price and some worrying financial indicators.
Right.
But what's at the heart of these struggles?
Yeah.
Why is Walgreens floundering while Pfizer, despite its challenges, seems to be finding its footing?
That's the key question, isn't it? And it speaks to a fundamental difference in their situations.
Okay.
Remember how Pfizer's going all in on innovation, on developing those groundbreaking new treatments?
Uh-huh.
Walgreens' situation's a bit more about, well, adapting to a rapidly changing retail landscape.
Adapting. What does that look like in practical terms? What's changing, and how is Walgreens trying to keep up?
Well, for starters, Think about how people shop for everyday items now compared to just a few years ago.
Right.
Online retailers have completely upended the traditional brick-and-mortar model, and that's had a huge impact on pharmacies like Walgreens.
Yeah, it's not just about picking up prescriptions anymore.
Right.
People have so many options for buying over-the-counter medications, health and beauty products, even snacks and household goods.
Yeah.
And let's be honest, convenience is king these days.
Exactly. And that's where Walgreens is facing an uphill battle.
Okay.
They've got thousands of physical stores,
Mm-hmm.
many in prime locations, but that also means high overhead costs.
Yeah.
And when you're competing with online giants who can offer lower prices and doorstep delivery, it's tough to stay ahead of the game.
Right. So it's not just about internal challenges.
Right.
They're also grappling with a fundamental shift in consumer behavior.
Precisely. And it's not like they're completely ignoring the problem.
Okay.
They've been working on expanding their online presence, offering more delivery and pickup options, and even partnering with other companies to broaden their reach.
Those sound like steps in the right direction.
Yeah.
Are those efforts paying off? Is Walgreens showing any signs of turning things around?
That's what makes their story so fascinating right now.
Okay.
It's a bit of a mixed bag.
Okay.
On the one hand, their digital sales have been growing, which shows they are making some headway in the online space. And their efforts to revamp their loyalty program and offer more personalized services are showing promise.
Okay.
And it's a big but.
Yeah.
They're still grappling with those unprofitable stores. They're facing increased competition, not just from online retailers, but also from grocery stores and big box stores that have expanded their pharmacy and health sections.
Right.
It's a crowded market, and it's tough to stand out.
So even though they're adapting, it might not be enough to compensate for the broader market forces at play.
Exactly, and that brings us back to that eye-catching 9% dividend yield.
Right.
Can Walgreens really afford to maintain that kind of payout with everything else going on?
Yeah.
Or is it a red flag, a sign that they're trying to keep investors happy while they figure things out?
That's the million-dollar question, and unfortunately the answers we have aren't very reassuring.
Right.
During the recent earnings call, when asked about the dividend, the CEO hinted at a possible cut. They said they were committed to the dividend,
Right.
but also needed to make sure it aligned with their long-term earnings power, which many analysts saw as code for a cut is likely coming.
Right.
Okay, so maybe not the most confident endorsement of their current dividend policy.
Right.
To me, this all adds up to a company at a crossroads.
Yeah.
It seems like there are valid arguments to be made on both sides.
That's what makes this such an interesting case study.
Yeah.
Even for those of us who aren't actively considering investing in Walgreens,
Right.
their future is uncertain, and there are a lot of factors that could influence whether they ultimately sink or swim.
So it sounds like the jury is still out on Walgreens. They're clearly facing an uphill battle, but they're not down for the count just yet.
Right.
But for investors, especially those who are drawn to that high dividend yield, it might be wise to proceed with caution.
Absolutely. It's all about weighing the risks and potential rewards.
Right.
Do you believe in Walgreens' ability to turn things around, to adapt to a changing market, and reassert its dominance?
Yeah.
Or are the challenges they face just too great to overcome? It's a gamble, and only time will tell who comes out on top.
This is what makes investing so fascinating, isn't it? It's not just about crunching numbers. It's about understanding the stories behind those numbers, the forces shaping these companies and their industries.
Absolutely.
Speaking of stories, I think it's time we shifted gears from the specific cases of Pfizer and Walgreens and zoomed out to the bigger picture.
Yeah.
Because whether you're bullish on big pharma or betting on a pharmacy comeback, there are some broader trends in the healthcare sector that every investor needs to be aware of.
Absolutely. Looking beyond individual companies, what are some of the major forces shaping the healthcare landscape right now? What's keeping you up at night thinking about the future of this sector?
Well, one trend that I find both fascinating and a bit daunting is the rise of personalized medicine.
Okay.
We're moving away from that one-size-fits-all approach to treatment and towards therapies tailored to an individual's unique genetic makeup, lifestyle, and environment. It sounds like something out of a science fiction novel.
It really does.
But this level of personalization must require some serious technological firepower.
You're absolutely right.
Yeah.
This shift is being driven by advances in fields like genomics, artificial intelligence, and big data analysis.
Okay.
We're now able to collect and analyze vast amounts of data about individual patients,
Right.
which allows us to develop more targeted and effective treatments.
It's incredible to think about the possibilities, but it also raises some big questions.
It does.
For example, How do we ensure that this data is being used responsibly and ethically?
Right.
And how do we make sure that these cutting-edge treatments are accessible to everyone, not just a select few?
Those are crucial considerations, and they highlight the importance of looking beyond the hype
Yeah.
and considering the broader societal impact of these innovations.
Yeah.
Healthcare investing isn't just about chasing profits. It's about understanding the complex interplay of science, technology, ethics, and societal needs.
It's a lot to wrap your head around, but it's also incredibly exciting.
Yeah.
We're on the cusp of a revolution in healthcare, and that creates incredible opportunities for investors who are willing to do their homework and think long-term.
Absolutely. And speaking of long-term thinking, another trend I'm keeping a close eye on is the aging global population.
Right.
People are living longer, which is fantastic. But it also means that we're going to see a surge in demand for healthcare services,
Right.
particularly for age-related conditions like heart disease, cancer, and Alzheimer's disease.
This demographic shift presents both challenges and opportunities. We need to find ways to provide high-quality, affordable care to a growing population of seniors.
Yeah.
And that's going to require innovation, not just in terms of new treatments, but also in how we deliver care.
Right.
It's like we talked about earlier with Walgreens, it's not enough to simply rely on old models.
Right.
The companies that will thrive in this new landscape are those that are adaptable, innovative, and responsive to the evolving needs of patients.
Precisely so. For investors who are ready to dive into the world of healthcare stocks, what key takeaways would you leave them with today?
First and foremost, I'd say, don't be afraid to think outside the box. Look beyond those familiar names and consider the smaller, more agile companies that are developing the groundbreaking therapies and technologies of tomorrow.
I love this, like that old saying, the stone that the builders rejected has become the cornerstone.
Right.
Sometimes the biggest opportunities are found in unexpected places.
Exactly. And remember, healthcare is a long-term game.
Right.
These trends we've been discussing, personalized medicine, the aging population, the shift toward value-based care, these are forces that will play out over decades, not quarters.
Absolutely.
So patience is key. Don't get caught up in the hype cycle or try to chase short-term gains.
Right.
Do your research, identify companies with strong fundamentals and a clear vision for the future, and be prepared to hold those investments for the long haul. Because ultimately, investing in healthcare is about more than just potential profits. It's about investing in a healthier future for ourselves and for generations to come.
Well said. And on that note, we'll wrap up this deep dive into the exciting and ever-evolving world of healthcare stocks.
Right.
We've covered a lot of ground today, from the specific challenges and opportunities facing industry giants like Pfizer and Walgreens to the broader trends shaping the future of healthcare.
Yeah.
Remember, knowledge is power, especially in the world of investing.
Right.
So keep those brains engaged, those portfolios diversified, and never stop learning.
Great advice.
Until next time, may your curiosity guide you and your investments flourish.
And to all of you listening, thank you for joining us on the deep dive. We'll see you next time.